Rynne TV coverage of the 2013 IRMI Energy Risk and Insurance Conference is sponsored by WebCE. During the IRMI Energy Conference in Houston, we had the opportunity to speak with Julian Garrish and Anthony Rynne with JLT PARK out of Bermuda. We discussed the unique challenges facing the energy sector, current insurance market conditions, and the future. Here are the highlights.
The industry is going through a phase of great development and new technology. Hydraulic fracking is obviously a relatively new technique, and that's causing a lot of concern amongst insurers, as is deep water drilling in ever deeper water depths. I think a lot of the initial concerns about hydraulic fracking perhaps polluting subsurface water tables has perhaps gone away a little bit, but there's no doubt that the concern remains about surface water. The process uses an enormous amount of water that's inevitably contaminated, and the disposal of that once it comes back to the surface is a concern for the insurance industry.
People have been doing this for a long time. It's just turned. It's quite different. Literally turned. It's now going horizontally instead of vertically. So it's creating a scare in the market. And with underwriters being concerned about everything these days, they're looking to find risk in this that concerns them at their levels.
And I think we've certainly seen a lot of reduction in available capacity, particularly for the offshore risks, particularly following the Macondo loss. An enormous amount of capacity has been withdrawn from the market, and that's had an upward effect on pricing and continues to do so.
Insurers, what they did after Macondo was start to look inwardly at what they have on their books and realize that if this had been a really serious situation with BP having been insured, and even as it is, they're insuring a number of clients on the same rigs and therefore having to pay out multiple times on the same loss.
In the Macondo incident, a number of insurers found themselves almost unexpectedly facing limits losses on 3, 4, sometimes 5 of their insureds, all arising out of one incident. They've taken a lot of corrective action on that, to the extent that the available offshore capacity now is half or maybe less than half what it was prior to that incident. So at the same time, you've got clients wanting to buy as much insurance as they can to protect themselves from those exposures. So it's pure supply and demand. Demand is going up, supply is coming down, and therefore prices are going through the roof, frankly.
Yeah, somewhat of an irony on the basis that there's a lot of capital actually in the insurance world, but the insurers are, by taking a much closer look at themselves and limiting the amount of capacity they're willing to put out in the market, they're actually causing a shortage of capacity in a very sensitive area, which is just above working layer capacity. And when you start to not be able to get it there, then it starts to have an impact further up the program. So pricing starts to rise from that level upwards. And then there's a lot of players who just want to play higher end programs with smaller amounts. Yeah. And rate relativities are very tight. So it means that, and we're primarily talking about the excess casualty world here too, in that sense, because that's mainly what we do in Bermuda, the two of us.
Yeah. And it may be that programs may have to be restructured. They may have to rethink retentions, because retentions as low as they used to be are not going to be available, and the sheer capacity limit is not going to be available, at least in the short term, as it was before. So I can see perhaps some alternative structures emerging, with perhaps insureds having to bear some more of their own risk in order to kind of balance off where the insurance market is and the industry is.
For more world risk and insurance news from the IRMI Energy Risk and Insurance Conference, visit the Rynne TV On Demand Library.